So what you mainly need to know about the accounting equation is that both sides of the equation just needs to match. Okay. So we're generally going to have 3 buckets that we're reporting everything in on what we consider one of the main financial statements, which is the balance sheet. And next week we'll actually have like a side by side so you can visually see it. So on our balance sheet, we have assets that could be checking account, business checking account, business savings account, business investment account. It could be grants or funding that we generated in the business. It could be vehicles that we've purchased, properties that we've leased or purchased. So those will all sit in the assets. Liabilities are who we owe, credit card, if we get a loan from the SBA or the state, if we get a small business bank loan, those are going to sit in our liabilities. And then we have owner's equity. Now, owner's equity is quite confusing. It may not make sense. It may take a couple iterations of explaining it, because all equity means is what is your ownership position in this company? How much did you put into the business? How much do you take out? That's it. And the net result of that, that's what equity is. So within equity, we're generally going to have things like, let's say, you wanted to start a business, and instead of trying to get funding or financing, you're just going to cut a check to the business from your own personal money. So that's considered an owner's investment in the company, an owner's contribution into the company. So it's going to sit in the equity because technically the business owes you that money back to get started. Okay. You can also have distributions you take out of the business, right? So if you're pulling money from the business's bank account, you're swiping the business's debit card for personal things, you're taking cash out to pay yourself back. Those could be owner's distributions, and they could sit in the equity section. Okay. So both sides of that equation simply needs to balance. Union, bank, JP Morgan Chase. If you want to go out and get like a line of credit instead of using your company's cash, they're going to generally ask for a balance sheet because they want to know how much cash are you keeping on the book? Are you taking a lot of cash out as an owner, or are you leaving some of it to be retained in the business? Do you carry a lot of debt, right? Because at the end of the day, when a bank or credit union, a financial institution gives us money, they want to make sure that they can make money on giving us money, right? So we have to be financially attractive for them to give us money. Okay. A liability is essentially, something we owe, a debt, an obligation to another company. That could be payroll. And then we have assets. Assets can be physical property that you own, which is our tangible resources. It could be the vehicle. It could be the actual location. It could be the actual inventory that you kind of house and keep. It could be tangible, but it can also be intangible, which is like the cash. Like nobody has stacks and stacks of cash, for their business bank account sitting in their business, right? So it could be intellectual property. It could be digital assets. So things that we can't physically touch, but it's still considered having some value, economic value that you own or the company owns. A creditor is going to generally be somebody we owe because we took out a loan, a credit card, or a line of credit. And then equities are going to be claim on the company's assets. So I kind of mentioned like the differences between stock, a company's stock, and a company's issuing bonds. So when a company issues shares or stock, that's going to be the shareholders having claim to those companies' assets. But in that video that they mentioned, remember, liabilities get paid first, not the stockholders. Okay. So not giving investment advice or anything like that. That's typically why we see some investors have a combination of stock positions and bond positions, because if a company is going out of business, bankrupt, guess who's getting paid first? The creditors, those that they owe a debt to. And then the net worth statement is basically a statement showing your entire value and relationship between your assets, your liabilities, and your equity. Any questions, clarity needed on any of these accounting terms.